As Wall Street worries about the Fed's aggressive rate hikes and a possible recession, our next guest says investors should be looking at one key part of the credit market for opportunity. Joining us here at Post 9 today, Monica Erickson, head of investment grade at DoubleLine. It's great to have you. Thanks for the time on a pretty good day for the tape, I guess. Your point is looking at IG corporates, right?
That's right. That's right. Yeah. So I focus on investment grade corporates.
What's the theme here? What's the thesis?
The thesis is that the Fed needs to control inflation, so they have moved very aggressively, very quickly. We've had 5 rate hikes in 6 months. We're now at 0.75% on the Fed funds rate. This is unprecedented kind of move in the federal funds rate, and so the Fed really needs to control inflation. So interest rates are going up, and in that environment, it's been historically very difficult for the Fed to do that without killing growth. And so our baseline is that instead of the Fed allowing rate hikes to flow through the system and have the natural effect that they would have, that they're going to continue raising rates. And so next year we could see a recession for sure, slower economic growth. So what do you do in that environment? Higher credit quality, bigger companies, better balance sheets, stronger business models, and investment-grade corporates.
You think the market understands that right here? I mean, given how flows have been last few weeks?
Well, I think what the market looks at are returns, and the market's been down 18%, the investment-grade corporate market, and again, unprecedented in terms of negative returns, excuse me. So I think flows have been based on what's been going on in terms of the returns in the market.
How about, it was a big weekend where we were starting to look at CDS and the threats of defaults and worrisome headlines.
Sure,
do you think those are accurately reflecting risk right here, or are we spooking ourselves?
Well, I think what I look at, again, is the investment-grade corporate market, and I look at spreads in that market, and I think spreads in that market are fairly compensating investors. They're definitely not as wide as they could be if we are in a recessionary environment. Right now, we get about 150 basis points over the equivalent treasury in that market. But to your point, there have been some specific credits where there's been a lot of volatility.
Right. So, and speaking of which, how do U.S. banks fit into your playbook at this point?
U.S. banks, we like. Very well capitalized. They're more like utility companies at this point. Their capital ratios have actually been brought up recently. And I think the large money center banks are in a very good position, even in an environment with slower growth. And it comes back to really what's going on in their balance sheets.
This is one thing where we're going to be on watch come earnings season to hear them talk about risk, certainly, and reserves. Do you think the picture is going to sound much different than what we're talking about right now, at least with the banks? Well,
the banks, their earnings have already suffered. Last quarter, earnings were very bad with the U.S. banks. Investment banking was down something like 50%. So from a credit investor standpoint, it's a little bit different than what an equity investor is looking at. We're much more concerned with what they're doing on the balance sheets, and the expectation is that earnings are probably not going to be that great. So we would expect more of that going forward. But at the same time, the banks have been shoring up their balance sheets, and I think their balance sheets can really withstand that economic weakness.
Other industry verticals where you think balance sheet strength is comparable here?
Yeah, and frankly, it's very different from some of the things that are going on in the equity market, for example, with retail, technology. So it's a little bit different than what might be going on with the equity, where, you know, they've got more cash than they do have debt outstanding on the retail side. So while there might be volatility on the equity side, it's a much different analysis that you're doing when you're looking at investment-grade corporates.
Right. You're not necessarily worried about inventories for back to school or holiday.
Right. I just want to know that they can pay us back, right? That they've got enough cash and cash flow that they can pay their bondholders back.
Finally, we're getting, fair amount of data the next few days, couple of weeks. Are you calling for the Fed to pause in November or do 50 and wait or anything like that?
I think today things seems to have shifted a bit, but the base case is that the Fed is going to continue raising rates. Inflation is still high. You've got, one print today, an ISM number that came in lower than expected. I think it's just one print. I think inflation is still there, and I think the Fed is committed to reining in inflation. And so the probability of them continuing on the path, I think, is higher than them shifting paths at this point.
It's a great way to look at the market through another cut in the diamond, through the balance sheet, as opposed to stocks as we talk about all day. Monica, thank you.
Thank you
Great
so
to
much
see
for
you.
having me.
Yeah.